Hello everyone. So today we will discuss about the subject income tax law and practices. So let's start with its introduction, or we can say the background behind the tax or the income tax. So if we take an example of a welfare state, the government takes primary responsibility for the welfare of its citizens as in matters of healthcare, education, employment, infrastructure, social security, and other development needs. To facilitate these government needs revenue, the taxation is primary source of revenue to the government for incurring such public welfare expenditure. In other words, government is taking taxes from public through its one hand and it incurs welfare expenditure for public at large through other. However, in general terms, no one enjoys handing over his hard earned money to the government to pay taxes. Thus, taxes are compulsory or enforced contribution to the government revenue by public. Government may levy taxes on income, business profits, or wealth, or add it to the cost of some goods, services, and transactions. So, moving further, let's have the overview of income tax law in India. So, there are two types of taxes: direct tax and indirect tax. The incidence and impact of tax fall on the same person directly is known as direct tax. On the other hand, the incidence or impact of tax fall on the persons indirectly is known as indirect tax, such as GST. It means in case of direct tax, tax is recovered directly from assessee who ultimately bears such taxes. Whereas in the case of indirect tax, tax is recovered from the assessee who passes such burden to another person and is ultimately borne by consumers of such goods or services. So, in general terms, we can differentiate direct tax and indirect tax in various points. So, first point is incidence and impact fall on the same person. In case of indirect tax, incidence and impact fall on two different persons. Second point, in case of direct tax, assessee has himself bear such taxes, thus it pinches the taxpayer. On the other hand, in indirect tax, tax is recovered from the assessee who passes such burden to another person, thus it does not pinch the taxpayer. Third difference, in case of direct tax, it is levied on the income of the person. On the other hand, in case of indirect tax, it is levied on goods and services. Thus, this type of tax leads to inflation and have wider base. Moving further, we should know about Income Tax Act 1961. So, Income Tax Act 1961 says levy of income tax in India is governed by Income Tax Act 1961. It extends to the whole of India, means it is applicable in every part of India. It came into existence on 1st April 1962. It contains sections 1 to 298 and various schedules. A section may be have subsections, clauses or subclauses. So if we talk about administration of tax laws, there is a hierarchy of administrative tax laws. On the higher position, there is Ministry of Finance, then Department of Revenue, having CBDT like Central Board of Direct Tax, CBIT, Central Board of Indirect Tax, and Custom. If we talk about sources of income tax laws in India, Income Tax Act 1961 contains provisions for determination of taxable income, determination of tax liability, procedure for assessment, appeals, penalties, and prosecutions, and power and duties of income tax authorities. Moving further, if we talk about charging section of income tax, which comes under section 4. So, charging section explain the characteristics of income tax as an annual charge of income. Means income tax is charged on the annual income of a person. Tax shall be charged at the rates prescribed for the year by the Annual Finance Act or the Income Tax Act 1961 or both. Income tax of previous year will be assessed in the next year, that is assessment year. It is charged on every person, means it is applicable on every person. So moving further, we would like to discuss Income Tax Rules 1962, various rules. The administrative of direct taxes looked by the CBDT, Central Board of Direct Taxes. For proper administration, Income Tax 1961 CBDT frames rules from time to time. These rules are collectively called Income Tax Rules 1961. So, moving further, before understanding the Income Tax Act, we would like to discuss various important definitions or terminologies which are going to be used while studying this subject. So, first, we will discuss about person which is disclosed in Income Tax Act under section 2 subsection 31. The term person includes the following: an individual, a company, HUF or Hindu undivided family, a firm, association of firm, body of individuals, local authority, and every artificial judicial person not falling within any of preceding category. So basically, this term belongs to indicate that who are the person on which taxes are applicable. So the list is front of you having various names like individual, Hindu undivided family, association of person, body of individual, partnership firm, company, local authority, artificial judicial person. Moving further, next we will talk about individual. So the word individual means a natural person, that is human being. Individual includes a minor or a person or an unsound mind. However, it includes both males and females. It also includes minor in case of assessment. Guardian or manager of the minor or lunatic person is entitled to receive his income. In case of deceased person, assessment would be made on the legal representative. Moving further, HUF, that is Hindu undivided family, consists of all persons linearly described from a common ancestor and includes their wives and unmarried daughters. Only those undivided families are covered here to which Hindu law applies. It also includes Jain and Sikh families. Once a family is assessed as Hindu undivided family, it will continue to be assessed as such till its partition. The elder co-partner of such HOF is called the Karta. Karta is the person who has the whole sole responsibility of running the business. Next, AOP, that is Association of Person. Association or group of two or more persons who join for a common purpose with a view to earn income with or without an agreement. In other words, if such person registered under the Partnership Act 1932, then it is called firm, otherwise it is called as AOP, means Association of Person. Next, assessment year and previous year. These terms are more important terms because understanding these terms help us to know the assessment year or calculation year of the person or individual. So, assessment year is defined under section 2 subsection 9, a period of 12 months commencing on 1st April and ending on 31st March of next year, in which income tax department will verify the income and tax submitted by person. On the other hand, previous year is defined under section 2 subsection 34 and 3. As per section 2 subsection 34, previous year means or as defined in section 3, as per section 3 means financial year immediately preceding the assessment year. Come moving further, we will discuss about the term income. Income word covers receipts in shape of money or money's worth which arise with certain regularity or expected regularity from a defined source. Under income tax, even any receipt which arise not from any definite source and not regular is treated under the definition of income as capital gains. According to section 14 of the Act, All income of a person shall be classified under the following five heads: salaries, income from house property, profit and gains of business or profession, capital gains, income from other sources. For computation of income, all taxable income fall under any of the five heads of income as mentioned by me. If any type of income does not become part of any one of the mentioned heads, it should be part of fifth head, that is income from other sources, which may be termed as residual head. So income chargeable under a particular head cannot be charged under any other. It means if one income is chargeable under the head of salaries, then it is not possible it is charged under the head profit and gains. The Act and self-contained provisions in respect of each head of income. If any income is charged under a wrong head of income, the assessee may lose the benefit of deduction available to him under the correct head. Moving further, next term is GTI or gross total income. Gross total income is the aggregate of income under all the five heads of income after adjusting the set off and carry forward of losses. Deduction under Chapter 6A is provided from gross total income to arrive at total income or taxable income. As I earlier mentioned, there are various five heads. First is salaries, then income from house property, profit and gains of business or profession, capital gains, income from other sources. The total of all these five heads is termed as gross total income. Moving further, what is total income? So, the total income of assessee is gross total income as reduced by the amount permissible as deduction under sections 80C to 80U. So, as I discussed, the total of five heads is known as gross total income. If we deduct deductions mentioned under section 80 to 80U from gross total income, then we will have the term total income. This total income is the income on which tax is to be implemented. Moving further, agriculture income. Section 2, subsection 1A of the Income Tax Act 1961 defines agriculture income as any rent or revenue derived from land which is situated in India and is used for agriculture purposes. Any income derived from such land by agriculture operations, including proceedings of agricultural produce, so as to render it for the market or sale of such produce. Moving further, we will discuss about the term tax planning. So, tax planning is a way to reduce tax liability by taking full advantage providing by the Act through various exemptions, deductions, rebates, and reliefs. In other words, it is a way to reduce tax liability by applying script and moral of law. It is the scientific planning so that we can attract minimum tax liability and we can shift our burden of tax through the help of concessions, allowance, rebates, and reliefs provided under the Act. So, next terminology is tax evasion. Tax evasion is the legal way to reduce tax liability by deliberately surprising income or sale or by increasing expenses, etc., which results in reduction of total income of the assessee. Tax evasion is illegal both in script and moral. It is the cancer of modern society and work as a clog in the development of the nation. Basically, tax evasion, we can say, is a method of avoiding taxes and keeping our income or wealth in our hand or either giving to it the government. Moving further, next term is tax avoidance. It is an exercise by the SSE legally takes advantage of loopholes in the Act. Tax avoidance is a practice of bending the law without breaking it. It is a way to reduce tax liability by applying a script of law only. There are two thoughts about tax avoidance. First, as per first thought, it is legal. Such thought is also supported by various judgments of the Supreme Court in various cases like Inland Revenue Commissioners versus Fishers Executors case in 1958, Srimati C. Kamla versus CJT in year 1978, and various other cases. So, as a student point of view, we must know the difference about the tax planning, tax avoidance, tax evasion, and tax management. So we will differentiate these terms with some distinctions of points. First point is feature. So tax planning is a practice to follow the provisions of law within the moral framework. Tax avoidance is a practice of bending the law without breaking it. Tax evasion is illegal both in script and moral. Tax management is implementation or execution part of taxation department of an organization. Second difference feature is object. To reduce tax liability by applying script and moral of law comes under tax planning. To reduce the tax liability to the minimum by applying script of law only comes under tax avoidance. To reduce tax liability by applying unfair means comes under tax evasion. To comply with the provision of law comes under the tax management. Next feature, benefit. In case of tax planning, generally benefits arises in long run. In case of tax avoidance, benefit arises in short run. In case of tax evasion, benefits do not arise but it causes penalty and prosecution. In case of tax management, penalty, interest, and prosecution can be avoided. Next difference feature is treatment of law. In case of tax planning, it uses benefits of the law. In case of tax avoidance, it uses loopholes in the law. In case of tax evasion, it overrules the law. In case of tax management, it implements the law. Next difference point is practice. Tax planning is a tax saving practice. Tax avoidance is a tax hedging practice. Tax evasion is a tax concealment practice. Tax management is a tax administration practice. On the morality ground, we will differentiate these terms as tax planning, it is moral in nature. Tax avoidance, it is immoral in nature. Tax evasion is illegal, and tax management is a duty. Hope you have understood about the difference between tax planning, tax avoidance, tax evasion, and tax management. So moving further, it's all about today's lecture.